Getting ready to buy or sell a home in 30, 60, or 90 days? Check out BundleSelect.com to find out how you could save 20% or more on your entire transaction, real estate, lending, and title. With BundleSelect.com, technology and a personal concierge are at your service to save you time and money. The real estate world is changing, and it's finally in your favor. BundleSelect's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. I'm here to tell you BundleSelect.com is the newest way to save money on real estate. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. We'll even take care of your move for free anywhere in the Bay Area. Visit BundleSelect.com. That's BundleSelect.com.
The 20% savings estimates are based on industry averages, and the free move is provided that the minimum amount of vendor savings covers the cost of the move. Real estate broker CalBRE 00466-902.
Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Kuchera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Kuchera.
Welcome in, Joe Kuchera with Real Estate Radio Live. Thank you for those tuning in and joining us today on Facebook. And be sure, before we get started, before I invite my guest in today, be sure to download the podcast. That's the best place to listen to the show, follow the show. Anything that you didn't get caught up on, it's the best place to do that. Also, we'd love to have the followers here on Facebook. It's growing at a nice clip and a nice rate, so continue doing that. Pass the word along. We're with you every day, and for more information, again, you go to RE Radio Live. For those who want to reach me during the week, you could reach me a couple different ways. Area code 408-838-9060, or you could also email Joe at reradiolive.com. All right, most of you know the show is focused on education and information, so what we would like to do is always have good guests like we have today to provide you, the listener, with education and information on a variety of different things. Our show is focused mostly on real estate, although it is focused really around helping people grow their wealth, maintain wealth, and a lot of different aspects of real estate. So let me invite my guest in today, Bernard ReSure with ReSure Financial. Good to have you, Bernard. How are you doing today?
Great. Good to be here, Joe.
Thank you for coming on today. Before we get started, if you could give our listening audience, please, a little bit of your background and then kind of your daily current roles and responsibilities, what you're up to today.
Yeah, I'm a CPA with the first background, both in due diligence and forensic accounting, as well as tax research and the traditional, services that you expect to see from a CPA. Mm-hmm. But I've always had, an eye out for those things that are innovative and service offerings that we can provide beyond our core client base. And among those things have been the formation of business entities and structuring business entities, mm-hmm. And in particular, self-directed retirement accounts for real estate investors. Very
good. All right. So we're also going to talk a little bit today, get a peek into this cryptocurrency taxation and free tax cryptocurrency investing. Is that right?
Oh, yeah, we can talk about that. And I'd say over the past, historically, self-directed retirement accounts have been used for real estate, some form of real estate investment.
Right.
Most recently, cryptocurrency has been, we've just been inundated with requests for cryptocurrency retirement accounts.
Very good. Yeah, we're going to get to that in the second part of the show here. So let's start a little bit and talk a little bit about LLCs, S-Corp, self-directed retirement. Maybe, I know we did an overview, but as that relates to real estate, talk a little bit about how to generate different types of taxable income in some of these concepts.
Yeah, and this is a rather timely topic due to the recent tax reform, Tax Cuts and Jobs Acts. There's been a lot of misinformation about restructuring and using entities and how that will impact your taxes going forward. Mm-hmm. There definitely are lots of planning opportunities, but there's also a lot of misinformation and and a lot more has stayed the same, for real estate investors than has changed. What I like to do is break out the different types of real estate related income, the different tax treatment they can have, and the various business entities and structures that can be used, and kind of do a mix and match. So we can see if, diversify, whatever your focus is on real estate, or if you'd like to diversify, what you should focus on, which entities you should use.
So you have the go ahead.
So with the, real estate, the first thing comes to mind is the traditional buy and hold real estate, your long-term play. Then you've got flipping, wholesaling, short-term rentals, your Airbnbs have become popular, and those are, for tax purposes, those are treated very differently than buy and holds. And then you have a third category, which include private lending, tax liens, mortgage notes.
Right.
So those are three different types of real estate investments, and obviously there are so many ways to approach real estate, but those are popular approaches, and they represent three different three different types of taxable income. Buy and hold, when we talk about taxation, so we think about income tax, we think about payroll taxes, and in real estate, we think about the tax shields that real estate presents, be that the depreciation, mortgage interest, the property taxes, and then you can amplify those using cost segregation. So there are lots of great built-in tax shields in real estate. So we have to think about all these various factors and see how they come together.
Right.
On the buy and hold side, so that's passive income, and that always that's where you have the built-in your built-in tax shield. When you hold those properties, you get to shield. The more you grow your portfolio, the greater your depreciation deductions are, and you get to protect that. And there are many real estate investors that never pay any taxes. They've got huge portfolios, and they never pay any taxes. And that kind of income, which is passive income, is not subject to payroll tax. So you pay the income tax at whatever your marginal income tax rate is, wherever you fall on the spectrum, but there is no payroll tax. And payroll taxes, those are the taxes that come off your W-2s, or if you're a 1099, it's your self-employment tax, and that's, if you're self-employed, you're paying over 15% in self-employment tax on your income, and if you're an employee, you're only seeing yourself pay about 8%, but economically, you're paying it all because wages would be higher if not for the fact that the employers had to pay that payroll tax.
Right.
So we've got the payroll tax, and we've got the income tax, and then so with the long-term buy and holds, you've only got the income tax. There is no payroll tax there, and you've got the tax shield. When you start looking at flips and wholesaling and short-term rentals, the tax code treats those more like an active business. That's not passive income. That gets to be an active business. It gets reported differently on the tax return, and you may have to pay payroll taxes on that. So that's an additional to the income tax. That's an additional 15% bite that comes out of your income for doing flipping, wholesaling, and short-term rentals. And when you pursue real estate, you shouldn't get too carried away with the tax implications, but it definitely is something that should be thought about anytime you analyze a deal. And at the other end of the spectrum, we've got the private lending and tax liens, which is ordinary income. You wouldn't generate any payroll tax on that, but that would be ordinary income, and there's no shield, no tax shield there. These are, private lending is it's lucrative, it's consistent. It's like having a bond that pays more than stocks. So I love private lending, but from a tax perspective, you're really, really exposed.
Yeah, I know quite a few people that really love this, and maybe speak to a little bit of that. So private lending is just what it talks about, Bernard. Basically, you could have an individual that either raises money or their own money, and they do private lending, and they may lend, whether you call it a hard money, private money, however you call it. So they lend on certain terms, and maybe someone they loan them $200,000 and for typically real estate? I'm guessing, is this typically real estate type ventures, and then they'll charge them, maybe an interest rate somewhere in the 8 to 10% range with a couple of points? Is that kind of the way these typically work over a period of time? Yes,
that's exactly it. And conceptually, it doesn't have to be confined to real estate. Mm-hmm. But being that ideally these, most lenders will want to secure their loan. There's nothing as secure as real estate, so that's where it's most common. Mm-hmm. And the terms are really all over the place. You can see 7%, 5%, and you can see as high as 15, 16, 17%. Mm-hmm. Everybody's got their own approach to it. Relationships. When if we would distinguish between hard money loans and private loans, a hard money loan would generally be associated with the higher interest rates, more points up front, coming from a professional lender. Mm-hmm. Somebody that may have a loan fund. You kind of may be syndicating on these things, taking an investor's fund and lending it out at these high rates. And a private loan brings to mind your neighbor, your friends, your family, people that trust you, and they're comfortable giving you that loan. They're not going to charge you points. They're going to want it. They're going to get a generous return. It'll be worthwhile for them, but it's going to be, the terms will be far more appealing than a hard money loan.
Got it. And that's a good business as well. We have let's chat a little bit. We're going to take a break in just a couple of minutes. Before we do that, talk about the distinct tax regimes that are applicable to real estate, maybe related investments. Maybe we could chat about that for a couple of minutes before we take our first break.
Yes. So with the different tax treatments, so then we'd have to match these to our different entities. Now, there are various types of entities that are out there for tax purposes, but for real estate investors, I would focus on the pass-through entities, which would be your sole proprietor, your single-member LLC, your partnerships, or a multi-member LLC that's taxed as a pass-through. Mm-hmm. And with those kind of structures, there's no tax levied at the entity level. It all flows directly through to the business owner.
Okay, great.
Then we've got S corps, and S corps are a bit of a hybrid. In an S corp, being that it is treated as a corporation, the business owner is expected to take a salary, expected to take a wage, and that distinguishes as opposed to. But what happens in an S corp is you're able to bifurcate your income. Mm-hmm. So when you've got a sole proprietorship or a single member LLC that just flows through, everything that goes, all your income is self-employment income, and it's all subject to self-employment tax, which is that 15% bite.
Got it.
But when you've got an S corporation, you can bifurcate. You can say, all right, I may have had $150,000 of income, but I'll have a salary of $60,000.
Right.
And I'll pay the payroll tax on the $60,000, and the balance I'm taking out of the profit distribution. So that distribution, being that it's not a wage, it's not a salary, you don't have that payroll tax on it. Mm-hmm. There's no, that 15% that you pay when you've got your own business, you don't pay that on your distribution from your S corp. So it allows you to save money on the payroll taxes, which can be very, very substantial.
Okay.
And the third entity that I like bringing in and we hear less about is retirement accounts. Retirement accounts come in many forms. You can get a tax deduction for a traditional IRA or traditional 401k, and the money in there will grow tax deferred, so there's no taxes until you begin distributing the money, which can be 20, 30, 40, 50 years down the line. Mm-hmm. And then there are the Roth retirement accounts, in which you pay the tax up front, but after that, it's completely tax-free. So if you're going to have great investments that you're expecting great returns, then you'd want to do the Roth.
Very good.
And these are the three entities, and there's one that I'm leaving out. A C corp is almost never applicable to real estate investment.
Okay. All right, here's what we're going to do. We're going to take a quick break, and we're going to come back. Stick with us for those watching us streaming live on Facebook. Following us, I'm with Bernard Reisz. We're talking, he's a CPA. Today's topic, he's with ReSure Financial. We're talking about kind of an overview of different industry. When we come back, tax, we discuss a little bit about the real estate components, some ways to make money, income. When we come back, I'm going to get into a little bit. I'm going to ask Bernard a little bit more about the cryptocurrency, only because that's a really hot topic right now. Everybody's trying to understand it. Some people think they know it. Some people may not. And we're going to come back, and so stick with us. This is Joe Kuchera with Real Estate Radio Live. We'll be back with you in about a minute. Stick with us to continue the show. Thanks.
For more information on today's program, visit ReRadiolive.com. That's ReRadiolive.com.
Getting ready to buy or sell a home in 30, 60, or 90 days? Check out bundleselect.com to find out how you could save 20% or more on your entire transaction, real estate, lending, and title. With bundleselect.com, technology and a personal concierge are at your service to save you time and money. The real estate world is changing, and it's finally in your favor. Bundle Select's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling services. Bundleselect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. I'm here to tell you BundleSelect.com is the newest way to save money on real estate. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. We'll even take care of your move for free anywhere in the Bay Area. Visit BundleSelect.com. That's BundleSelect.com.
The 20% savings estimates are based on industry averages, and the free move is provided that the minimum amount of vendor savings covers the cost of the move. Real estate broker RE 00466
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit ReRadiolive.com. That's ReRadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live. Thank you again for those following us on Facebook. Remember, for more information, you can always go to ReRadiolive.com. That's ReRadiolive.com. Be sure to download the podcast. A lot of exciting stuff coming up. You've heard some announcements already. The next couple of weeks, we're going to have some other big announcements to make. We also, remember, usually once a week, we have Jack Russo on. We're talking about entrepreneurship, startups in Silicon Valley, some of the aspects around that. He'll be back on Friday. Be sure to tune in. But today we have on the line our guest, Bernard Reisz, is with ReSure Financial, and he's talking a little. He's a CPA, and he's talking about real estate as it relates to some investment strategies. He covered some of the different components of that when we opened up the show, and then discussed some different ways to generate, different types of taxable income. He went through that, discussed that, and then right before we took a break, Bernard was sharing with us a little bit about some of the distinct tax regiments is really applicable to real estate and related to investment. So let's spend some time now, Bernard. I know, again, it's a hot topic. A lot of people still don't understand it. Maybe what we could do, this whole cryptocurrency, you're going to speak to the tax application of it and how it applies, but can you talk a little bit about the, what this, try to make it in layman terms or common sense? Some people still are trying to figure out, like, what is this thing? Is it a coin? Is it something I buy? Is it something I trade? Is it like money? Maybe you give us kind of a quick overview, and then from your perspective, and then we'll talk a little bit about some of the implications around tax.
Yes. So it is, it's an intangible, so it is difficult to get your head wrapped around it. This was introduced, the first cryptocurrency was Bitcoin, introduced by the anonymous Satoshi Nakamoto. Close to 15 years ago was when this concept was first introduced. And the idea is to have a decentralized currency, right. Whereas today our currency, we trade dollars. And we accept them. You go into a store, you can buy a cup of coffee with $1. Mm-hmm. I didn't give you gold. I just gave you a piece of paper. And that piece of paper and the amount of it in circulation is managed by by the Fed and by central banks throughout the world. And that has different impacts on economies. Right. So the idea here was to introduce something that kind of transcends governments, is not controlled by governments. And if we were to adopt this as a currency and willing to exchange for goods and services, this would be decentralized. It's very efficient, And one of the things, the technical innovations that were introduced was the ability to avoid what was called the double spend problem. So if you spend a Bitcoin or you transfer it, although it's electronic, it's lost to you. It's kind of like if you take $1 out of your pocket and you give it to coffee shop, you can't, that dollar is gone.
Right.
So up until the blockchain innovation, you can kind of do anything electronically. How do you keep somebody from spending it and then keeping it? So blockchain provided the ability to move these bits and bytes because they are intangible, and have a record of who had it and where it went. And once you lose it, it's gone to you. Now, whether or not this will really be a long-term play depends on whether or not we adopt it as a currency. It's been gaining ground, but it's still too soon to say.
Yeah. So what happens then when someone, the taxation part of this, and so explain a little bit, is it treated the same way as regular revenue or money or income, or is it different? Or talk a little bit about how that works.
So initially, people really didn't give any thought to the tax treatment, or nobody imagined they would have actual taxable income from this. And in particular, even if there would be taxable income, you would expect that you have that income when you cash out. So if you bought Bitcoin a couple of years back, it appreciated in value incredibly, and then you cashed out, that may be reasonable to expect that you would have to pay some taxes. But suppose you started with Bitcoin and then you sold some of your Bitcoin or exchanged some of your Bitcoin for Ethereum. Right? There are so many coins out there. There are just so many of them. And the way you get into it is you buy Bitcoin, and from Bitcoin you can trade into the others. Bitcoin is just the most mainstream, so it's Bitcoin and Ethereum and Ether. But once you're in there, there are literally new coins being introduced every day. So when you trade one for the other, and you don't put any cash in your pocket, you just exchange some bits and bytes for some other bits and bytes. Should you recognize taxable income? And people are shocked to learn that as far back as 2014, the IRS said that yes, this is a capital asset. It's property. It's like personal property. And if you trade personal property, you have to recognize income in the amount of your, the fair value of whatever you traded up to. So, and to bring it back to real estate, if you buy a piece of real estate and you pay $500,000 for it, and leaving out, all the complexity, your basis in the property, your initial basis in the property is $500,000. If you subsequently sell that for $1 million, your taxable income is the difference between your tax basis, which is the amount you paid for it, and the amount of income the amount of money, revenue you have from it. And in that case, that would be $500,000. Similarly, with cryptocurrency, somebody bought Bitcoin way back when it was a couple of cents, and then he cashed out when it's worth $19,000, so that he would have about $19,000 of gain per each coin that he sold. But what happens, where it gets thorny, is if he took that Bitcoin when it was $19,000, and rather than cashing out, rather than taking fiat, as they say in industry parlance, he swapped that for some Ethereum or for some Dogecoin or Litecoin or Ripple. So he got $19,000 worth of Ripple in exchange for that Bitcoin, in which he only had a basis of a couple of pennies. The IRS says there's income recognized at that point. He's got no cash. This fellow may be cash poor, but he now has $19,000 of taxable income. And he's got to come up with the cash for that. And the people that bought lots of Bitcoin and did very well, so this is magnified for them because they just have these incredible gains. And if they traded one cryptocurrency to another, they keep having, recognizing these gains.
All right. Very good. Well, let's do this. Before I let you go, I'm going to talk a little bit more about some structures, some tax structures, maybe some other things. But before we do that, also, Bernard, if you could give the listeners, for those that may want to reach out to you or connect with you, if you could give maybe a phone number, email, or website, what's the best place to reach you?
All right. Our website is 401kcheckbook.com. And through that website, that's a service that we provide nationwide, or more accurately, worldwide, is helping people set up entities, and there's a special focus on self-directed retirement accounts with checkbook control. That's 401kcheckbook.com. I welcome all emails at Bernard@ReSureFinancial.com. That's Bernard at RESURE Financial.com.
Very good. Let's do with the last couple of minutes we have left. All these new tax laws that came into place. I think people, for the most part, they're starting to sink in and understand them. What is your? Well, I have a quick question for you. What is your interpretation? The one we're getting a lot is the home equity line on the property. First, it was $100,000. You could deduct all the interest, and then it was thought that no matter what, it's not tax deductible. But now we're hearing again that it is up to $100,000 as long as you could prove that went back into the property. Can you iron that out for us?
Yeah, I'd be glad to. We get this all the time. So it's pretty clear. I've got to get back to the fundamentals. So I think we should talk for a moment about what the law used to be.
Okay.
And then we talk about what it is now. And there's a lot of the confusion is really because the law really was never clear to most of us.
Right, good point.
So prior to this, there were two kinds of deductions that were available: tax deductible mortgage interest. There was your home acquisition indebtedness, and that was available for up to $1 million in debt. Mm-hmm. Deduct interest. Any such interest on that loan was tax deductible, even though it was for a personal expense.
Okay.
And then on top of that, we had the HELOC, which you can take a home equity line of credit, and that was deductible on interest on debt of up to $100,000. So it's important to define what those really are. The home acquisition indebtedness refers to a loan that you take to buy or improve a personal residence. Mm-hmm. Now, if you took a mortgage on, and you mortgage your property and you used it for something other than the residence, it doesn't necessarily fall in that category.
Okay.
And if you went to the bank and you took out a HELOC, what the bank calls a home equity line of credit,
yes.
When it's structured, it's not amortizing, it's interest only, but you put that and use those proceeds to improve your personal residence, that would fall under the home acquisition indebtedness.
Okay. So
that wouldn't be a HELOC. That would actually belong to the category in which you had up to $1 million.
Oh, I see.
So
okay.
To distill this, it's not about what the bank calls the loan. It's about how you use the proceeds.
Okay.
And there are two other ways you can use these proceeds. If you take out even today, if you take out a home equity line of credit, but you use that money to buy your investment real estate, that's going to be deductible because that's a business expense. This discussion about home equity line of credits and home acquisition indebtedness, mm-hmm. that all applies when you're using the funds for personal needs. If you take out some sort of loan secured by your personal residence, but you use it for a business pursuit, that was always deductible because that's a business expense.
Okay, very good. Well, that's great. Thanks for clarifying that. That was a big one. We're getting a lot of questions about that, so I appreciate that. We're out of time. We'll have you back in a couple of months if we can, Bernard, to go over some of this stuff because there's so many things related to tax. And I think as 2018 gets underway and it settles in with some of these new tax laws, I'm sure you'll have more to share with us.
Yes, looking great being here. Looking forward to being back on the show again. And I'd say this, as long as it's after March 18th, after April 18th, I'm good.
Right, all right. Yeah, we won't bug you till after April 18th. All right, thanks for coming on. Bernard is with us, kind enough to spend the time. Again, if you want more information about Bernard, what he does, his company helps people in a lot of different ways. I would recommend going to his website. It is 401kcheckbook.com. Again, 401kcheckbook.com. ReRL.com. Thanks again, Bernard, for spending some time with us. Appreciate it very much.
All the best. Take care, Joe.
Yeah, you too. This is Joe Kuchera, the Real Estate Radio Live. Thanks again for checking in today. Remember, for more information, you can always go to ReRadiolive.com. Take care until next time.
You've been listening to Real Estate Radio Live. For more information on today's program, visit ReRadiolive.com. That's ReRadiolive.com. Subscribe to our podcast. Discover more at ReRadiolive.com.